Passive income sounds like this. You set something up once, then money hits your account forever, and your time becomes yours again. In real life, it often looks like this. You quit your job. 2 months later, the market drops. Your passive rental has a vacancy. Your dividend stock cuts the payout, and suddenly you're not relaxing. You're doing math at midnight. The pain isn't just financial, it's emotional, because you did what you were supposed to do. Save, invest, be responsible. And yet you still feel one bad year away from going back to work. Today, we're going to clean up the confusion, not with hype. With systems and numbers, here's the central question. What kind of passive income actually buys freedom in the real world, especially when markets are messy and life is unpredictable? Big claim. Most people chase the wrong definition of passive. They optimize for the type of income: dividends, rent checks, royalties, when the real goal is something else. Stability plus flexibility plus inflation resistance. In this video, you'll learn a simple framework I call the 3-layer freedom stack. Layer 1. Keep the lights on money. Layer 2. Don't sell at the worst time protection. Layer 3. Grow faster than inflation growth. We'll walk through how it works, then we'll do the math with clear assumptions, and finish with practical steps you can use without turning your life into a second job. Educational only, not financial advice. Let's define the problem with one sentence: passive income fails when it can't handle stress. Stress is things like a market crash early in retirement, inflation being higher than you expected, a major repair, medical cost, or family emergency income streams that look passive, but demand your time. So here's the mechanism that works better than just live off dividends. The 3-layer freedom stack, layer 1. Baseline income stability. This is the money that covers your essentials: housing, food, utilities, insurance, basic transportation. This layer can come from a part-time job you actually like, social security, say if for later years, a pensioness if you have one, some dividends or bond interest, a small business that's stable. The point is not maximum return. The point is minimum panic. Layer 2A, the shock absorbers, bad timing. This is cash or short-term, low volatility assets that keep you from selling stocks after a drop. Because the most dangerous moment isn't the market is down. It's the market is down and you're forced to sell anyway. Layer 3Z, growth S inflation fighter. This is your long-term portfolio, often broad index funds. Sometimes real estate, sometimes a mix. This layer is what keeps your purchasing power alive for decades. If you only have layer 3, you'll feel rich on paper and stressed in practice. If you only have layer 1, inflation can slowly squeeze you. If you ignore layer 2, one ugly stretch can derail everything. This is how passive income becomes real. It's not one stream. It's a design. Meet Carla. Carla is 41. She works in operations for a healthcare company. Good salary, high stress. She wants out, but she's not trying to retire to nothing. She just wants control. Carla used to think the plan was simple: get to 1.5 million, pull 4%, done. Then she actually tried living like she was retired for 1 month. She tracked her real essentials, not the aspirational budget, the real one. Mortgage, property tax, insurance, 2,000 100 month, groceries, plus basics, 6,600 failures a month, utilities, plus internet, plus phones. 3,500 a month, car fos, fuels, maintenance, average of 500 a month, health insurance out of pocket, average 700 a month, other essentials 400 a month, total essentials about 4,700 a month. Call it 56,000 a year. Now here's where she got smart. Instead of aiming for 100% passive income forever, she built the freedom stack layer 1. She picked up a low stress weekend role doing scheduling support for a local clinic, remote, 12 hours a week, brings in funds 500 a month after tax. Layer 2A, she built a cash buffer of 18 months of essentials. Layer 3, she invested the rest in a diversified portfolio and stopped trying to micromanage dividends. Her friends told her the weekend job defeats the point. Carla didn't care, because her goal wasn't to never work. Her goal was to never be trapped. And now, when the market has a bad year, she doesn't feel like she's watching her future burn. She feels boring. Stable. That's the win. Let's run Carla's numbers in a clean way. We'll use simple assumptions, essentials of 56,000 a year weekend roll income, The 18,000 odd a year after tax remaining essentials needed from portfolio 38,000 a year is your initial portfolio 200,000 inflation assumption. 3% long run portfolio return assumption not guaranteed. We'll just model a range and focus on sustainability mechanics. Step 1. What withdrawal rate is Carla actually using? She needs 30,000 from a 1.2M portfolio. That's a 38,000 a third and 200,000 pre 319%. Notice what happened. Carla didn't need a magical investment. She lowered the pressure by using layer 1. Step 2. Why the buffer matters. Now add layer 2, say 18 months of essentials. 18 months of essentials is 66,024, 667 per month, 667, 18 to 84 hours. So Carla keeps about 84K in cash or short-term instruments. Is that optimal for returns? Maybe not. But here's what it buys if the market drops 25% in year 1. Carla can reduce withdrawals from stocks temporarily and use the buffer instead. This is the key. You don't have to follow a rigid rule every year. You need a plan that survives ugly sequences. Step 3 is a reality check on dividend only. Let's say Carla tries the classic dividend dream. If she wants 56,000 in dividends and expects a 3.5% yield, she'd need a 56,000 or 0.045. A 1.6 million in dividend yields aren't guaranteed. Companies can cut them. Funds can change distributions. Taxes apply. Inflation still applies. So the never sell shares approach can require a larger portfolio while still not protecting you from life events. The stack approach often lets you retire earlier with less stress because it's built for reality, not for a spreadsheet. Here are the mistakes that turn passive income into a new kind of job or a fragile plan. Once confusing gross cash flow with net income. A rental that collects $2,500 a month is not $2,500 passive income. Vacancy, repairs, insurance, taxes, and management can change everything. Correction, track net income over a full year and assume something will break. Tooth over, optimizing yield. High yield can mean high risk. Some stocks yield more because the market expects trouble. Correction, focus on total return fluff diversification, not just the payout rate. Thrillers, ignoring early retirement timing risk. Bad markets early can do more damage than bad markets later because you're withdrawing when prices are down. Correction, use a buffer and a flexible spending plan, not a rigid number. 4, underestimating healthcare and random life. In the US, healthcare costs can be a retirement deal breaker. Even if you're healthy. Correction, build a margin. Model higher than expected costs. 5, retiring from work, but not to a life. Boredom creates spending, and boredom can pull you back into stressful work. Correction, plan your time like you plan your money. Visual pacing suggestion. Wallane 25 images, action steps, I-90, 30, 1100s. Here's a simple checklist you can use this week. General education only. Step 1 team, separate, essentials. From nice to haves, write 2 numbers. Bare minimum annual essentials, comfortable lifestyle annual spending. Most people only track the comfortable number. That's how the target keeps moving. Step 20, build your layer 1 plan. Pick one. Part-time work you can tolerate, a skill you can freelance, a small service business, a later start income source, like social security planning. The goal, cover 20% to 40% of essentials. That alone can change everything. Step 3, build layer 2, the shock absorber. Aim for 12 to 24 months of essentials and cash gather short-term holdings. More if your income is unstable. Less if you have strong flexibility. Step 4, keep layer 3 simple. For many people, a diversified low-cost portfolio can be a solid core. Avoid strategy collecting. Complexity feels productive, but it can create mistakes. Step 5, stress test with 2 scenarios. Market down 30% in year 1, inflation higher than expected for 3 years. Ask, what do I cut? What income can I add? What does the buffer cover? If you can answer those questions calmly, your plan is stronger than most. Passive income isn't a button you press. It's a system you build. If you remember one idea, make it this. Freedom comes from not being forced to sell assets at the worst time and not being forced to live on a rigid plan. The 3-layer freedom stack is simple. Layer 1, stable baseline income so you don't panic. Layer 2 and a buffer so bad timing doesn't wreck you. Layer 3, growth so inflation doesn't slowly drain your life. Now I want to hear from you in your situation, which is harder. Building the money or trusting the plan when markets get ugly, drop a comment with money or trust and tell me why. If you want more calm, math first investing videos with no hype, subscribe and watch the next video where we break down how to estimate your real retirement spending without guessing.